Here's how I see 2019, and I think that's as much as you can focus on. I'm playing it this way. Give me any company with transparency on its free cash flow that I can trust for the rest of this year, and I'm going to own that name. So I'm moving to more conservative names, Pfizer, J&J, Boeing, and here's my thinking. I got to stay long the market because I don't know if Trump's going to get a trade deal. If he does, it's straight up 15%. If it includes no more technology transfers and some kind of IP protection. If that happens, you're going straight up. Could be 20%. Meanwhile, I got to sit in the weeds with free cash flow, getting 2.5% div yield, and I'm looking for 5% capital appreciation. It's a 7% year. That's all you're going to get. And no, financials will not lead. That's where you take money to die. Tech isn't going to work this year. It's going to be flat. Everybody with free cash flow that's transparent, you go there.
Okay. Josh, the so-called dash for cash would suggest that it's not sustainable. You look at the new data from Lipper, right? Wall Street Journal writes about it today. I know you were following this article closely. Yeah. You've got assets in money market funds have grown by more than $2 billion this month.
Right.
That's the fastest pace in a decade. That suggests that people have used the pop to sell and put more money in cash.
I think there's a bunch of, I think it's the story of the day today. And I think there's a bunch of things going on here. And the first one is that cash is now competitive with at least the dividend yield in the S&P. And there are a lot of advisors, investment management companies that are taking advantage of the fact that cash is no longer a big zero. So that's one thing. But I think the fear of what happened in the fourth quarter last year has not abated just because we've had a big bounce off the bottom. You take a look at the S&P, it's an epic bounce. Let's just call it what it is. 72% of S&P 500 stocks are now at a 20-day high. It's very good. However, there are almost no 52-week lows. We are still below the 200-day. You've still got sectors that are rolling over, even with this bounce. And I think that you still have that fear is lingering. And last year, look, you talk about how great a trade deal would be. I do agree you'd get a big move in the market up. But that doesn't mean that you're going to get a new high. And until you make one, I still think that the psychology has shifted dramatically. Yeah. Last year, you had 24% earnings growth, down 5% in the S&P. So if you get a good trade deal, doesn't necessarily mean a good outcome for the stock market.
Yeah, you're still a ways off, Tep, from a new high. Morgan Stanley says retest is still relatively high, the odds of one. How do you see it?
Yeah, I don't see us retesting the lows anytime soon.
Why not?
I think it's really all boils down to what the Fed's doing, right? And they've really changed their language since October. And they've started to really emphasize the word patient. So from my perspective, as long as the Fed remains patient and they don't decide to raise rates recklessly, I think you end up hitting 2850 by the end of the year on the S&P 500. So in the 13 to 20.
So, okay, because you go back and get a retest or something close, you're talking 2450. So you're giving up 200 points from where you are now.
I don't see us retesting the low.
200-point jump the other way.
That's the way I see it, yeah. So we don't see a recession until at least the second half of 2020. And in the 13 to 24 months leading into a recession, the average annualized returns are 14%. So we do see a market rally from here.
Okay, Steph, I turn to you. How do you see it? I mean, as somebody who watches earnings very closely, the EPS beats have been pretty good. Not that much on the revenue side. I mean, you're barely over 50%. Of companies beating on revs.
It's early.
I know, but you've had a lot of big companies report. Come on.
It's early. I'm going to just say that. It is absolutely early. Less than 5% of the companies in the S&P 500 reported. So, but I mean, I'll give you've had Stanley Black & Decker, you've had FedEx, you've had Apple, but you've also had good earnings from the banks. So, and they actually were able to rally. And I think the action is very telling. So, yeah, I do, too, want good cash flow companies, strong managements, good balance sheets, buybacks, dividends, but at a certain price. I mean, some of the companies, the defensives, some of the names even that you were just mentioning, Kevin, J&J and Pfizer. I mean, I own Boeing. I own some of those companies, but they're not exactly super cheap. And I think you really want to be very, very stringent on valuation. So we've been talking about slowing growth. We've been talking about slowing economic growth around the world.
Yeah, for a reason, right? I mean, you got more weak data out of China.
Yeah, but we've been talking about slowing growth, decelerating growth for over a year. That's why we went from 19 times to 14 times. So I think you can find sectors and stocks in this market that are high quality, that are actually at a good valuation. And again, the banks are your example on that.